Problem 1613. To record 2018 income tax journal entry, we need to acknowledge the permanent difference from this interest income and temporary difference of their installment sales. This problem also offers some estimation of the likelihood of realizing the tax benefit, meaning those deferred tax liability. If the current year's taxes can be deferred, that's called tax benefit. We will first work on our tables before any consideration of these probabilities, and then we will factor in these probabilities. So here, the pre-tax accounting income is $90 million. So in 2018, pre-tax accounting income, $90 million. We have one permanent difference. When the company purchased municipal bonds, the interest income from municipal bonds are not taxable. That's based on the tax law. It's not because of the accrual accounting. So interest income of $15 million is not taxable. We minus 15. After permanent difference, we will list temporary differences. Here we only have one temporary difference because it says there are no differences between accounting income and taxable income other than those described above. Described above includes interest income and installment sales. So $60 million of installment sales is not cash yet. They didn't collect cash. So no, if it's not cash, no cash inflow, you don't need to pay tax. Therefore, we have taxable income for 90 plus a negative 15 plus a negative 60. So taxable income is $15 million. Tax rate is 40%. Therefore, income tax payable is 15 multiplied by 40%, $6 million. Installment sales will be taxed when cash is collected. And here they told us 2019, 40% of $60 million is collected. 60% of $60 million is collected, which is $36 million. In 2020, 40% of $60 million is collected, which is $24 million. So in 2019, we need to pay tax on $36 million of cash inflow. In 2020, we need to pay tax on $24 million of cash inflow. Tax rate is always 40% in this example. So if I draw a line between 2018 and 19, I can find out deferred tax liability balances at the end of 2018. So future taxable amount, future of 2018 means 2019 and 2020. So 24 plus 36, totally $60 million will be taxable in the future of 2018. So after 2018, totally there will be $60 million taxable. And after applying the tax rate, we can calculate deferred tax liability, which is $24 million. So deferred tax liability T account tells me how much change I should make for deferred tax liability. It starts with 0 balance because this company didn't have any temporary difference. The ending balance should be 24. So the change during the year is $24 million. The first requirement asks us, what portion of tax benefit of tax-free interest will True recognize on its 2018 tax return? That's the first question. And financial statements. That's the second box. Let me make sure. So what portion of tax-free interest on tax return form? Second question is interest. What portion of the interest will be recognized on the financial statements? Okay. So the first box is about the tax form. Before we consider the likelihood of upholding this tax position, 15 million tax interest income is not taxable. So on the tax form, 40% multiplied by 15, $6 million is the tax benefit. On the financial statements, that means accounting income. Interest income needs to be included into income tax expense calculation. So 0 benefit is recognized on the income statement, on the financial statements. The third question A says, what portion of the tax on the $60 million installment sales will True defer on 2018 tax return? So on the tax return, we already calculate all 60 million will be reversed in the next 2 years. So 60 multiplied by 40%, $24 million will be deferred. And then 3B says, what portion of the tax on the $60 million income from plot sold on installment basis will True defer in financial statements? On the financial statements, we need to consider the percentage likelihood. US GAAP says we will take the amount, the benefit will be take the amount that has cumulative percentage of likelihood higher than 50%. Cumulative likelihood. So we start from the first option, 20% plus 20%, and then 20%. So totally 60%. That's when it exceeds 50% of likelihood. So 40 out of $60 million can be deferred. That's the tax benefit on financial statements. So 40 multiplied by 40% of tax rate, we will have a deferred tax liability for $16 million. And then requirement 4 asks us to journalize. Requirement 4 says prepare journal entry according to prepare journal entry for income taxes in 2018, assuming full recognition of tax benefits. So both 15 interest income and all $60 million of installment sales don't need to pay taxes. Then we will credit income tax payable for $6 million and this X of deferred tax liability for X amount, and then debit income tax expense to balance the entry, 24 plus 6. That's requirement 4. The journal entry is like this. And then requirement 5 says, prepare the journal entry to record income taxes in 2018, assuming the recognition of the tax benefits in the financial statements. In the financial statements, you indicated in requirement 1, 2, 3, not the tax form. Okay. So, if on the financial statements, $15 million of interest income is not tax deductible. On the financial statements, only 40 out of $60 million can be deferred. So we will do another journal entry. Income tax payable is still the same. Okay, follow this $6 million. Deferred taxes, though, from requirement 3B, okay, only $40 million can be deferred. So 40 multiplied by 40% of tax rate, that is $16 million. Besides these two, we have additional taxes. We put them into liability. Projected tax, additional tax. Okay. So that is calculated by $15 million not tax deferrable multiplied by 40%. That's interest income. Also, only 40 out of 60 can be deferred for installment sales. So 20 out of the $60 million cannot be deferred. Needs to pay tax. So 15 multiplied by 40% plus 20 multiplied by 40%. That is $14 million. Then the last step will be the income tax expense. To balance the entry, it will be the total of credit, 16 plus 6 plus 14.